Did you know that 90% of mutual fund investors pick funds based on last year's performance and end up losing money? But what if I told you there's a scientific way to screen mutual funds that could potentially help you identify funds with 30% plus returns? In today's video, I'm going to reveal the exact 7-step screening process that professional fund managers use to pick winning mutual funds for September 2025. Before we dive into the screening process, let me share some shocking statistics. According to recent data from August 2025, funds like SBIPSU Fund have delivered a massive 32.05% 3-year CAGR, while Franklin India Opportunities Fund has given 31.88% returns. But here's the catch: most investors never find these gems because they don't know how to screen properly. The biggest mistake investors make is chasing last year's winners. This is like driving while looking in the rearview mirror. What we need is a systematic approach that looks at multiple parameters, not just historical returns. Let me introduce you to the 7-step screening framework. Step 1 is defining your investment objective. Are you investing for retirement, buying a house, or creating wealth? This determines whether you need equity funds, debt funds, or hybrid funds. Step 2 is assessing your risk tolerance. Can you handle a 20% drop in your portfolio value? If not, high risk small cap funds aren't for you. Step 3 is determining your investment horizon. Short term goals under 3 years need debt funds or liquid funds. Medium term goals between 3 to 7 years can use balanced funds. And long term goals above 7 years are perfect for equity funds. This is crucial because equity funds can be volatile in the short term but historically deliver superior returns over the long term. Now let's get into the technical aspects that separate successful investors from the crowd. The first parameter is historical returns, but we don't just look at 1-year returns. We analyze 1 year, 3-year, 5-year, and 10-year returns to understand consistency. For example, UTI Nifty Next 50 Index Fund has shown consistent performance with 13.10% 3-year CAGR and a massive AUM of 23,731 crores. The second critical parameter is risk adjusted returns. This is where metrics like Sharpe ratio, alpha, and beta come in. The Sharpe ratio tells us how much extra return we're getting per unit of risk taken. Alpha shows us if the fund is beating the benchmark after adjusting for risk. A positive alpha of 4 means the fund performed 4% better than the benchmark. Beta measures volatility compared to the market. A beta of 1.3 means the fund is 30% more volatile than the market. The third parameter is expense ratio. This is the annual fee charged by the fund house. Ideally, we want this below 1% for equity funds and below 0.5% for debt funds. Every percentage point in expense ratio directly reduces your returns. For instance, if two funds give the same gross returns of 12%, but one has 0.5% expense ratio and another has 1.5%, your net returns become 11.5% and 10.5% respectively. Fund manager track record is equally important. Look for managers with at least 5 years of experience who have managed funds through different market cycles. Portfolio composition analysis helps us understand if the fund is taking concentrated bets or is well diversified. Too much concentration increases risk. Let's now implement this screening process and look at some top funds for September 2025. Based on our analysis in the thematic category, SBIP SU fund stands out with 32.05% 3-year CAGR and low cost. It's suitable for passive investors. Remember, screening is just the first step. You need to regularly review your investments every 6 months to ensure they remain aligned with your goals. Market conditions change, fund managers change, and your personal situation evolves. Don't set and forget, stay actively involved in monitoring your investments. Most importantly, never put all your money in one fund. Diversify across categories, fund houses, and investment styles. Start with SIP investments to benefit from rupee cost averaging, especially in volatile market conditions like we're experiencing in 2025. The key takeaway is this: successful mutual fund investing isn't about finding the next hot fund, it's about following a disciplined screening process, staying diversified, and maintaining a long term perspective. If you follow this 7-step framework, you'll be ahead of 90% of investors who pick funds based on emotions or last year's performance. If this video helped you understand mutual fund screening better, please hit the subscribe button and press the bell icon for more such content. Your financial future deserves systematic planning, not guesswork.